Hello, my financial accounting students. Today we're going to cover Chapter 7, Accounting for Receivables. Mostly we're talking about accounts receivable today, but we will also deal with notes receivable and also a little bit with interest receivable and interest accruals toward the end of the chapter. The good news is we already know a little bit about accounts receivable. Back at the beginning of the semester, we asked the question, well, what do we do if we let a customer buy now and pay later? And what do we do if they don't pay us? What if they take a long time to pay us, or what if they never pay us? And here in Chapter 7, we find out the answer to that question. So first, we're going to be learning how to use the percent of revenue method to account for what they call uncollectible accounts expense. So I want to define some of these terms a little bit better. Big picture this chapter, in terms of dealing with amounts that we don't collect from our customers. That's what they refer to as uncollectibles. In prior versions of the text, and to be honest with you, in the real world, we don't use the term uncollectible accounts expense. It's typically called bad debts expense. So to the extent that a customer doesn't pay us, we call that a bad debt. That was changed, I guess, in academic la-la land a couple years back because we don't want to hurt anyone's feelings, of course, and if we use the word bad, that's offensive. So apparently now we're stuck with the term uncollectible accounts expense, but I will be the first to forewarn you that your textbook does not use that consistently, that there might be spots that you will see in your homework in the textbook itself that use the term bad debts expense. So please know that uncollectible accounts expense and bad debts expense can be used interchangeably. So as we navigate through this chapter, the big picture is we're looking at two different methods for dealing with uncollectible accounts. The first one that we're going to look at is the allowance method. And within the allowance method, there's two different techniques that we'll study, percent of revenue and percent of receivables. Both of these fall under the allowance method, and they are GAAP. They follow generally accepted accounting principles. Overall, the allowance method is a little bit more difficult than the direct write-off method, but it's going to result in more accurate numbers, and it also follows conservatism and matching concepts, which are obviously part of GAAP. The direct write-off method we will cover briefly after we look at the allowance method. I think you're going to like the direct write-off method. It's easier, but it's not GAAP. It does not follow GAAP. It does not adhere strictly to conservatism or matching concepts. However, we can justify its use in certain situations, and you often will see it used by small businesses or even medium-sized businesses that don't have a lot of receivables or they don't have a lot of uncollectible accounts. So we'll talk more about the direct write-off method when we get there. But big picture, allowance method versus direct write-off method. Allowance method follows GAAP. Direct write-off method doesn't. Within the allowance method, we'll look at two techniques. And the one that you should really focus your studying in on is percent of revenue technique. You will have, I think, just one or two questions on your test about percent of receivables. I think you'll have it in one homework problem, but the majority of your study should focus on percent of revenue technique, which is part of the allowance method. So before we get further, we need to define some terms, understanding the difference between accounts receivable and notes receivable. When a company allows customers to buy now and pay later, we call that accounts receivable. And typically these receivables are small and payable within, say, roughly 20, 30, even 45 days. But there are small receivables that come up in running the business, in the ordinary course of what that business does. How do we define small? Well, they're relative to what the company sells. In contrast, we could have notes receivable, and notes receivable is typically used for longer-term credit when the amount is large, and when the company might require the customer to issue a note specifying the terms, meaning the interest and a specific due date. They could even ask for some form of collateral. So notes receivable is typically going to be used in longer term, larger amounts. It is possible that we could have notes receivable arising from what we ordinarily do, but I will tell you right now, this textbook and what you're going to see in your homework, your quizzes, and your tests, the only time notes receivable comes up is when the company we're doing accounting for loans money out to some other company, and then we need to collect that money back. So they use it in notes receivable in the context of loaning out idle cash, and accounts receivable is only used in the context of doing what we're ordinarily in business to do. Is it possible that notes receivable could arise from doing what we're ordinarily in business to do? Yeah, it could. Let's say that we have a customer that has an unusually large order. They come to us and they say, we need to buy $1 million worth of widgets from you. I know that's, triple the amount that we usually order in an entire year, but we have this great opportunity. And do you think that you could long-term finance us on this business deal? So we could have notes receivable arise from an unusually large order from a customer, and in that case we might specify interest rate, specific payment due dates, and get it a little bit more formal, and that would make it notes receivable. Net realizable value. This is a really important term in terms of understanding the allowance method. We've talked about the idea that when we allow customers to buy now and pay later, meaning accounts receivable, we might later find out that some customers are unwilling and or unable to pay their accounts receivable. Some of them will be dissatisfied and just won't want to pay us, and others have good intentions, but they don't have the cash in order to pay us. So when that arises, we need to consider what we're going to do. We've talked about the idea of not overstating assets on our balance sheet before. We never want to overstate our assets. And here they're reminding us, because we do not want to overstate our assets, we must show our accounts receivable at its net realizable value on the balance sheet. And put in simple terms, that means what we actually think we're going to collect. It would be quite naive and ignorant to believe that we are going to collect every single dollar of accounts receivable. Most likely, at some point, somebody's not going to pay us. And as much as that's frustrating and harmful to our business, that's the reality. If we allow customers to buy now and pay later, at some point, somebody's not going to pay us. As an owner or a manager in a business, we need to be aware of how often that comes up and how much that costs us. And we also need to be very careful that we're not overstating our accounts receivable. We want to show it on the balance sheet at net realizable value, meaning what we actually believe we can collect. Technically, how we compute net realizable value is we're going to take our gross amount of our accounts receivable, so meaning our total in accounts receivable, and then we're going to subtract some estimated allowance for doubtful accounts. So that's the part that we really need to dig in here. What is this allowance for doubtful accounts? So first, I'm hoping that you've already read the chapter and you're aware of a new account called allowance, or allowance for doubtful accounts. It is a contra asset account. I believe this is our first time dealing with any form of contra account. And if you're familiar with the term contra, it means opposite or against. So if we have a contra asset, it's an opposite asset. So a normal asset carries a debit balance. Allowance is still an asset, but it's an against asset. It's an offset asset, and it carries a normal credit balance. So allowance is going to be a contra asset to accounts receivable. It will be an offset against accounts receivable, and you'll see here shortly how we present that on the balance sheet. So think of allowance as like a negative asset. And then we need to figure out how we're going to estimate. And I do want to touch on that briefly. So often in accounting, we think everything is very precise. It's all very black and white. There's one way to do it, and there's a right answer and a wrong answer. And while that might be true on your homework, your quiz, your test, it tends to be true in the classroom. But in reality, we deal with estimates in accounting all the time. We find ourselves in positions where we have to be conservative, we have to do our best to match, and we don't have precise numbers before us, so we somehow have to come up with an estimate. And you'll see that both this chapter and again in chapter 8 as well. So here we have to estimate our allowance for doubtful accounts. So we have two techniques within the allowance method. The first one that we're going to look at, and the one that we'll probably use the most, is the percent of revenue method. And it's actually the easiest of the two. All we're going to do is multiply our revenue, in this case it's going to be service revenue, by the percentage estimate of uncollectible accounts, and that's called the percent of revenue method. So we'll take a look at that as we look at Allen's Tutoring Services. So Allen's Tutoring Services recognized $3,750 of service revenue on account in year 1. So given that, we're going to be debiting accounts receivable and crediting service revenue. So we see our accounts receivables going up, we see that revenue goes up, bringing up our net income and therefore bringing up retained earnings. So both sides of the accounting equation are increasing. And of course, no cash flow yet because we didn't collect anything from our customers. Then, event 2, ATS collected $2,750 cash from accounts receivable. So now the customers have paid us part of what they owed us, right? So we're debiting cash and we're crediting accounts receivable. So cash is going up, accounts receivable is going down, and we have $2,750 of OA, operating activity cash flow. But what we're looking at here is an asset exchange, right? What's the remaining balance in accounts receivable? I might suggest that as you go through this lecture, you might want to keep a T account. Just have out a pencil and paper and keep a running balance of accounts receivable and maybe allowance as well. So right now it was $3,750 and then we collected $2,750. So our balance in accounts receivable right now would be $1,000, right? Okay, so here they're showing us our accounts receivable balance is $1,000, and we need to see what's happening next here. ATS recognized uncollectible accounts expense for accounts expected to be uncollectible in the future, and they believe that amount's going to be $75. Now, let me start with saying I have no idea how they came up with that number. They didn't specify their technique for arriving at this number. It must be based on past experience. But please notice, nothing bad has happened yet. There is no customer that said, I'm not going to pay you. Nobody said anything specific. So we don't know what customer or what amount. This is simply an estimate that we've made, knowing that not every customer is going to pay us every time, because that's a bit unreasonable. So this is just based on past experience, based on an estimate. We think that $75 of that $1,000 will end up not being collected. So what we're doing here is, this is the step I call establishing the allowance. I'll give you 4 steps for the allowance method here in just a moment. So this would be step 1, where we're establishing the allowance, and we're going to debit a new expense account called uncollectible accounts expense. For short, maybe UAE. We use that to abbreviate. This is what we used to call bad debts expense and what the real world calls bad debts expense. So we're going to expense that $75 now. And then we're crediting our new contra asset account called allowance for doubtful accounts, or just allowance for short is fine. So what we see in terms of our accounting equation, our assets are going down because allowance is a contra account and we're crediting allowance. And then we're debiting uncollectible accounts expense, which is going to bring down our net income and therefore bring down our retained earnings. Okay, so step 1, like I said, establish the allowance. There's going to be 4 steps to the allowance method, and I will lay them each out for you. So establish the allowance, and then we're going to debit uncollectible accounts expense and credit allowance for doubtful accounts. And over here on the side, I'm going to keep a running balance in our allowance account. So right now we have a credit of 75. So what we're indicating is that we're anticipating that of this $1,000 of accounts receivable, we don't know anything specific, but we think we're really only going to collect 925 of it. And while that's based on an estimate, according to GAAP wants us to show 925 on our balance sheet to both be conservative and to match. So we're being conservative by not overstating our assets and misleading the readers of our financial statements to think that we're going to collect more than what we actually will. But we're matching by expensing the $75 now in the same period in which we show the related revenue. So if you remember the third part of the matching concept, I'm sure you've been springing out of bed each morning reciting the matching concept, right? So part one says we want to match our revenues to the period in which they are earned. Part two says we want to match our expenses to the period in which they are incurred. And then there's that part three. Sometimes, but not always, we want to match our expenses to the revenues they generate. Well, this $75 expense here to uncollectible accounts expense, if we're trying to match that, we should match it to the same period in which we showed the related service revenue. So even though nothing bad has happened yet, we're going to go ahead and expense it so that we're adhering to GAAP in terms of both matching and conservatism. All right, so you've got this part down in your notes, right? You're going to write out all 4 steps, and we'll keep a running total in our allowance T account. And on our financials, let's take a look at what's going on. So we've got our cash at $27.50, what we actually collected from the customer. Accounts receivable still shows $1,000 on the debit side, and then just below it we show allowance for doubtful accounts, and it has a credit balance of $75. And then over in our temporary accounts, we've got revenue of $37.50, and we've got $75 of uncollectible accounts expense. And again, matching and conservatism. We're matching this $75 expense to the same period where we're showing the $37.50 of revenue. And also at the same time, we're being conservative. On our balance sheet, we're going to display accounts receivable less allowance equals $925 of net realizable value. And that's exactly what we see here. In the middle, we have our balance sheet, and it shows accounts receivable less allowance, and then it shows net realizable value. So for the readers of the financial statements, what they see here is 925 is what we actually think we're going to collect. It's okay that it's not perfect. It's okay that it's based on an estimate, because we're doing our best to adhere to matching and conservatism and therefore follow GAAP. So our income statement, $37.50 minus $75 of uncollectible accounts expense. We've got $36.75, and again, we're being conservative by not overstating our net income and matching that $75 expense to the same period in which we show the related revenue. And then on the statement of cash flows, we just have the one inflow from customers of $27.50. So pretty short, sweet financial statements, but a couple of new things to think about there. So we move into year 2 at Allen's Tutoring Services, and we start the year by writing off an uncollectible account. So ATS wrote off $70 of uncollectible accounts receivable. To be honest with you, in business, deciding when to write something off is often difficult. Unfortunately, a lot of times customers or clients don't communicate clearly with you, or they tell you exactly the opposite of the truth. So for example, if we're trying to collect $70 from a customer, and we might, mail them a bill or email them a bill, and then if they don't pay after a while, we're wondering, well, what's going on? Are they going to pay? And we might call them up, and they might say, you know what? I just totally forgot, and I will mail you a check. Do you think they're really going to mail us a check? How long should we wait? Well, if they mean it, of course, it'll arrive very quickly. But others will say that they're going to mail you a check, and then they don't. And then you wait and you wait and you wait. It would honestly be a lot easier if the customer would just be really brutally honest. As an accountant who's dealt with a lot of accounts receivables and trying to collect from customers, I would actually much prefer if those customers would be brutally honest. If I called up and said, hey, I was just trying to collect that $70, I would prefer if they would tell us, you know what? Your tutoring service is horrible. I'm totally dissatisfied. I hate it. I never want to use you again. And you can take that $70 and shove it where the sun don't shine. Oh, why, thank you. That's very clear business communication. Now I understand that you're not going to pay that bill, and I will write it off. That would be a lot easier for me as the accountant, rather than somebody stringing us along, telling us, oh yeah, I forgot, I'm going to pay later. Oh, I'm going to do it. Yeah, I'm going to pay. I would much rather somebody just say, forget it. It's not happening. So either way, ATS determined that this $70 is not going to be paid. So at this point in time, they have specific information about a specific dollar amount and a specific customer who says they're not going to pay. And therefore, we're going to do a write-off. So what we're doing here, we're debiting allowance for doubtful accounts. We're using up some of that allowance. Remember it carries a normal credit balance. And now we're using up some of that credit balance. So we're debiting allowance, and then we're crediting accounts receivable, bringing accounts receivable down. So if we look at our accounting equation, what's going on here is that both of these accounts are going down. We're really just shifting $70 from one to the other. So it's an asset exchange. And what we see down here, this is an important key point this chapter. Before we did the write-off, our net realizable value was $925. 1,000 minus 75 equals $925. After we do the write-off, our accounts receivable balance is now down to $930, and our allowance balance is down to just $5. And our net realizable value, it's still at $925. So nothing has changed in terms of our net realizable value. As the accountant, this is kind of the I told you so moment. I knew something bad was going to happen. I estimated $75, and sure enough, I was pretty close. Here we are with a customer who's not going to pay us $70, and now we have to write it off. So this was our kind of aha, I told you so moment where we're using up this allowance. We planned ahead for this. And what I really want to emphasize is that we're not expensing this again. There is no expense over here. We already expensed the $75 previously anticipating this. And so now we're just using up our allowance. So in terms of our steps, we did a write-off. So that's step 2, where we debit allowance for doubtful accounts and we credit accounts receivable. So just shifting from the contra asset and the asset, we're moving that $70 around. So here in our T account, we show a $70 debit. So our remaining balance in allowance right now is $5 on the credit side. So technically, we're still anticipating another $5 of non-payment from our customers. So we go about our business in year 2. ATS provided $10,000 of tutoring services on account during year 2. So we debit accounts receivable, credit service revenue. So accounts receivable is going up and revenue is going up, which brings up our net income and therefore our retained earnings. Nothing's going on under cash flow because nobody's paid us yet. And then ATS collects $8,430 of that accounts receivable. So we're debiting cash, crediting accounts receivable. So cash goes up, accounts receivable goes down, and now we've got OA cash flow. So what's our balance in accounts receivable now? Have you been keeping track? Okay, so you have how much in accounts receivable? $2,500? That's what I've got too. I'm sure you've been using your pencil and drawing out T accounts as we go, right? All right, so what happens next here? ATS recovered a receivable that it had previously written off. Okay, so you know our customer that previously told us that they don't like our tutoring service and they're not going to pay us the $70? Well, they had a little change of heart. I guess they slept on it for a bit and they feel bad about it and they're still not going to pay us the full $70, but they've decided to pay us a whopping $10. As the accountant, this is the part where I just roll my eyes and say, why? But anyhow, in terms of understanding our steps here, we're going to reinstate the $10. So before we can collect the $10 from the customer, we already wrote it off. So now we have to unwrite it off, which is called a reinstatement. So essentially we're just doing a write-off backwards. So now we're debiting accounts receivable, putting the $10 back into accounts receivable, and we're crediting allowance, putting the $10 back into allowance. So what we see down here is another asset exchange. So we're just swapping $10, pushing it back into accounts receivable. So in terms of our steps, that's step 3, a reinstatement. And to be honest with you, it's rare that reinstatements happen in the real world. When we get to the point of deciding to do a write-off, we're usually right. But sometimes it happens, and first you would reinstate it, and then in step 4, we'll look at collecting. So we are debiting accounts receivable and crediting allowance, and so we see our $10 credit in the allowance T account. So then we can collect. So the collection part is simple. We debit cash and credit accounts receivable. So cash is going up by $10, accounts receivable going down by $10. Again, just an asset exchange. And now we actually have some cash flow, $10 operating activities. So our step 4, of course, is that collection, debit cash and credit accounts receivable. So that's the 4 steps of the allowance method. One thing I do want to point out as we do this, step 1, where we establish the allowance, that's the only step where the income statement is affected, where we debit uncollectible accounts expense. After that, steps 2, 3, and 4, those are all just asset exchanges. We're just pushing numbers around on the asset side of the equation, and hopefully getting to this point of collecting some cash down here. But in terms of impact on the financial statements, 2, 3, and 4 are all asset exchanges. So the only one that impacts our income statement or really changes our accounting equation at all in terms of its net effect is step 1, where we establish the allowance. So it's the end of year 2. And this time we're going to more clearly use the percent of revenue method. ATS recognized uncollectible accounts expense for year 2. The company estimates that 2% of its service revenue will eventually prove to be uncollectible. Our service revenue for this year was $10,000. And if we multiply that by 2%, our uncollectible amount we believe is going to be $200. So what we're going to do with this, that's our estimate, and it's just based on the percent of revenue. So that's the whole technique. You take the percentage, you multiply it by the revenue, and we decide that $200 is going to be uncollectible, and therefore we expense that $200. So we're back at step 1 again. At the end of each accounting period, we're probably going to do step 1. Whether or not steps 2, 3, and 4 ever happen, that depends on the situation, but every accounting period we should be doing step 1, establish the allowance. So we're debiting uncollectible accounts expense and crediting allowance for doubtful accounts. And we see that down here, we're expensing the $200, bringing down our net income and therefore our retained earnings, and we're crediting our contra asset account allowance. So in terms of our T accounts, let's see, we've got cash at $11,190. Here in accounts receivable, we see we wrote off the 70 up here, and then down here in steps 4 and 5, we see the reinstatement and the collection. So we're reinstating here in step 4, and then we're collecting the $10 in step 5. We have an allowance now of $215. So what's our net realizable value? Can you compute it? Accounts receivable has a balance of $2,500, and we subtract our allowance of $215. So we're expecting to collect how much? Our net realizable value will be $2,285. That's what we actually think we're going to collect. So if we take $2,500 of accounts receivable less allowance of $215, we have net realizable value of $2,285. And again, The allowance method is adhering to GAAP, specifically matching and conservatism. Here in our income statement, we're matching this $200 uncollectible account expense to the same period where we show the $10,000 of revenue. And we're also making sure that we're not overstating our net income. That's conservative as well. And of course, on the balance sheet, like I just pointed out, we have our net realizable value. So it's conservative to not overstate our accounts receivable. We don't want to lead the readers of our financial statements to believe that we're going to collect more than what we actually can. So again, it may not be completely precise. This allowance figure is just based on estimates, but we're doing our best to adhere to GAAP and specifically matching and conservatism. So next here, we're going to take a look at the percent of receivables technique. We're still talking about the allowance method overall, but this time we're going to be focusing on percent of receivables rather than percent of revenue. So this is a different company, Pyramid Corporation, and at December 31st, year one, they have $56,000 in accounts receivable, and they've got $500 credit balance in allowance for doubtful accounts. And they're telling us here that Pyramid estimates that 6% of its accounts receivable ending balance will be uncollectible. So they just take that ending balance, 56,000 times 6%. And when we compute that, we get 3,360. But what I really want to emphasize here is that is our desired ending allowance balance. So we need to force the balance in our allowance T account to be 3,360. Okay, that's not necessarily what we're going to expense. That's what the ending balance has to be in the allowance account. Okay, so that's what makes this method a little bit different. So remember, they told us that we already had a beginning balance of 500 in the allowance account. And if we need the ending balance to be 3,360, then we only have to expense 2,860. So we're still doing the same 4 steps. Step 1 is establish the allowance. So we're going to debit uncollectible accounts expense and credit allowance for doubtful accounts. But the amount is 2,860, not the full 3,360 because there's already 500 there. Okay, so we're going to expense 2,860, bringing the allowance balance to 3,360. And in terms of our accounting equation, we see that we're expensing the 2,860, bringing down our net income, and therefore bringing down our retained earnings. And then allowance for doubtful accounts over here, that should actually show as negative numbers, right? That's a contra account. So that should be negative. There we go. That looks better. So negative 2,860 equals negative 2,860. So both sides of the accounting equation are going down. So the way I look at it, the percent of receivables method wants us to have a relationship between our ending balance and accounts receivable. Excuse me. A relationship between our ending balance in accounts receivable and our ending balance in allowance. And from an accounting perspective, this makes a lot of sense. It's actually more accurate than the percent of revenue technique, that we think a certain percentage of our accounts receivable won't be collected. Not a percentage of how much money we made that year, but just overall of our accounts receivable. So they think 6% won't be collected, and therefore they want to have an allowance in place of 6% of that, meaning 3,360. Well, if there's already a beginning balance in allowance of 500, well then the amount that we need to expense is just the difference in between of 2,860. So if you follow this, we're just kind of backing into that figure. So if I were a student doing this, I'd draw up all my T accounts, I'd put in my ending balance in accounts receivable, I'd compute the 6% and the desired ending balance for allowance. Knowing that we have a beginning balance of 500, then I'm backing my way into the 2,860, which is then what I'm going to use to expense to uncollectible accounts expense, UAE, and that's what gets used in step 1, establish the allowance. So we only need to expense 2,860 to force the balance to be 3,360. That's really the nuts and bolts of the percent of receivables method. It is viewed to be a little bit more difficult than the percent of revenue, simply for this right here. That when you compute this, that's the desired ending balance, and then you mathematically back your way into the amount that you're going to expense. That's really the hiccup with this, this technique. Okay, so we're going to take a look at what they call an aging schedule. So we're going to use the accounts receivable aging schedule for pyramid. So like I said earlier, they have $56,000 in their accounts receivable. And here we're going to take a little more detailed look at it. They've laid it out by when those receivables are due. So all the current receivables here, $26,500 in this column. But then anything that's past due is showing up here to the right. So we've got $11,700, that's 0 to 30 days past due, and so on. $13,100, that's 31 to 60 days past due. $3,000, that's 61 to 90 days past due. And we have $1,700 here that's over 90 days past due. Do you think we're ever going to collect that? It's pretty iffy, to be honest with you. If they were going to pay you, they probably already would have. I get some students that'll say, oh, well, you know, I think it's more likely they'll pay because they've had more time to get the money together to pay you. That's really nice thinking, but maybe a bit naive. Statistically, the longer it takes for somebody to pay you, the less likely it is that you will ever collect from them. So over 90 days is definitely danger zone. So what we're going to do with this information, they have a company policy essentially that they apply these percentages of likely to be uncollectible. So of the current accounts receivable, they believe only 1% will be uncollectible. But notice those percentages get higher as they become more past due. So they think that of the $1,700 that's over 90 days past due, that it's 50-50 as to whether they'll collect it. So what they've done then is multiply their balances in their receivables, organized by number of days past due, by the percentage likely to be uncollectible, ranging from 1% up to 50%. And they have computed that over here. So now using this aging schedule, they're coming up with a different number. They want their desired ending allowance balance, they say required allowance account balance, to be $3,760. So of that $56,000, they believe $3,760 is going to be uncollectible, and therefore they want to have an allowance in place ready to do write-offs if and when that happens. So again, they're saying the required allowance balance is $3,760. We already have a balance of $500 in allowance, and therefore our uncollectible accounts expense is just the difference between the two. So we're backing into the $3,260. So notice that we don't just expense $3,760. We have to look at our beginning balance and allowance. So again, here's another example of step one, establish the allowance. So we're debiting uncollectible accounts expense for $3,260 and crediting allowance for $3,260. So again, both sides of the accounting equation are going down. We expense it, bringing down our net income and therefore our retained earnings. And then our allowance for doubtful accounts is a contra asset account, so it's going down on the asset side. So again, if I were a student, I'd be drawing out my T accounts. So I draw out my accounts receivable account, and I put in the ending balance of $56,000. And I have computed that I need the ending balance in allowance to be $3,760. It has a beginning balance of $500. So the amount that I need to expense is just $3,260. And that's what's going to go to uncollectible accounts expense. Okay. And so that's what they did here. They debited uncollectible accounts expense for $3,260. But this is how I would compute it if I were a student working on a homework problem or a quiz problem, something like that. So that completes the part of the chapter on the allowance method. Now we're going to move into the direct write-off method, which is another way of handling uncollectible accounts, or bad debts as we call them. You might see this used more in small businesses. Businesses maybe that don't have a large amount of uncollectibles could also use this. It doesn't follow GAAP, as I mentioned earlier, but it's possible that we could justify the use of the direct write-off method if the amount that gets written off annually is essentially immaterial. It's not a big deal. It wouldn't influence the readers of the financial statements because it's just a small amount, and the trouble of going through the steps of doing the allowance method is more than it's worth. So we can use the direct write-off method in some circumstances with small businesses that don't have to strictly adhere to GAAP, or even businesses that do have to adhere to GAAP and they can justify it because the amount is immaterial. The amount is small and irrelevant to the big picture of their financial statements. So we're going to look at Allen's tutoring services again, but now using the direct write-off method. So going back to year one at ATS, they have $37.50 of revenue on account. So that's the same, debit accounts receivable, credit service revenue. Now this time, we're not going to make any entry at at year end to estimate our uncollectible accounts because they believe that the amount is immaterial, and we're not using the allowance method. So there is no establishing an allowance. There is no 4 steps. There is no allowance account. So we don't need to worry about that aspect of it. So then in year 2, we determine that the customer isn't going to pay us $70. So the customer says, we didn't like your tutoring, we're not going to pay you, forget the $70. So now we just write it off. Now, we didn't plan ahead for this. There is no allowance established because that's not part of the direct write-off method. So when this happens, we just expense it. So we're debiting uncollectible accounts expense and we're crediting accounts receivable. So essentially in the direct write-off method, we just expense things when they go bad. So we're going to expense this account receivable if the customer says they're not going to pay, or it's gotten so old that as a company we've determined that it's not ever going to get collected. So really that's the most of the whole method, is that we just write it off when we find out that a specific customer and a specific amount won't be paid. Okay. So later that year, ATS collects $10 from the account that had been previously written off. So the same scenario as before, the customer that wouldn't pay us the $70 has now had a change of heart and decides to pay us only $10. So we do have to reinstate that before we can collect it. And the way I want you to think of a reinstatement is it's always the opposite of a write-off. So if we're using direct write-off method, then we do the opposite of however we wrote that off. So on the previous slide, our write-off was debit uncollectible accounts expense, credit accounts receivable. So now to do our reinstatement, we do exactly the opposite, flipping that journal entry over. We debit accounts receivable and we credit uncollectible accounts expense. Does it seem strange to credit an expense account? This is correct over here. This is supposed to be a negative expense, which is bringing up net income, and our accounts receivable is going up. So both sides of the equation are going up. So this is a rare circumstance where we're crediting an expense account. That should feel a bit strange, but given our situation, we wrote something off and now we're undoing it. We're reinstating it. So we have a good reason to be crediting an expense account in this case. And then we can collect. So once the account is reinstated, now we can collect the cash, debiting cash and crediting accounts receivable. So that's really the whole thing. We see cash going up, accounts receivable going down. We see our cash flow of $10 operating activity. And that's the entire direct write-off method. Don't you think that was a bit easier? Most people do. Direct write-off method tends to be easier. It tends to be what I think comes more naturally in terms of how non-accountants think of bad debts or uncollectible accounts, is that you just expense them when you determine they can't be collected. And so I think you'll see a lot of small businesses tend to use the direct write-off method, and hopefully their uncollectible accounts are immaterial. If their uncollectible accounts or their bad debts become large, They probably need to do a little investigating as to what's going on there. We'd like to think that that amount would be relatively low, and it might be okay for a small business to use the direct write-off method. So that's the whole scoop. So next we're going to talk about notes receivable and accrued interest. So earlier I mentioned that when we talk about notes receivable, at least for this course, when we speak of notes receivable, it's in the context that we apparently have idle cash and we're going to loan it out to another company or another person, and then they're going to pay us back at a later date plus interest. So here's a look at a promissory note. So this might be, a promissory note's the document that we might use to formalize a notes receivable agreement. So we have the amount, we have a date, we have the name of the person or the company that we have loaned that money to. And so it says Stanford Cummings promises to pay Allen's Tutoring Services $15,000 on October 31st, 2019. So it's for 1 year, right? Because we loaned them the money on November 1st, 2018, and they're going to pay us back a year later plus 6% interest, and they've offered collateral of their car title. So to the extent that they don't pay us back, we could potentially get their vehicle. So that's a basic promissory note with the basic components. But from an accounting perspective, what do we do with this? So looks like, here's what happened. On November 1st, year 3, ATS loans $15,000 cash to Stanford Cummings. Cummings issues ATS a note promising to repay the loan with interest in 1 year. So we're debiting notes receivable, which is an asset account, and we're crediting cash. So debit notes receivable, credit cash, that's just an asset exchange. And that cash flow over here is IA, investing activity. This is not what we're in business to do. We're not in the business of loaning out idle cash for the purpose of collecting interest. We have loaned out this money hoping to make some money, make some interest on our idle cash. So it's an investment. So we're loaning out money and we want to collect it back plus interest later. And this is happening on November 1st. At the end of year 3, ATS must accrue the interest on its note receivable. Now, going back, when we say accrue, remember that means recognize before realize. So Cummings has not paid us back the $15,000, nor have they paid any interest. But as a function of time elapsing, interest is happening. So we have to accrue, we have to recognize that interest before we collect it. When will we collect it? Well, we're going to collect it when they pay the loan, which will be on October 31st of next year. So not yet. So no cash is changing hands. We're just accruing the interest. And here's how we compute it. We take the principal times the percentage times the time outstanding. So we take 15,000 times 6%. That by itself, that would be how much interest we're going to make in a whole year. But a whole year hasn't gone by. Only 2 months have gone by, just November and December. So we're going to take 2/12 of that amount, and we have $150 of accrued interest revenue. So we're going to debit interest receivable, and we're going to credit interest revenue. So our revenue's going up, but we'd want to be careful we don't mix it in with our sales or service revenue. This is interest revenue that we want to show separately in our income statement. That'll make our net income, and therefore our retained earnings go up. And then we are debiting interest receivable. We're missing that label here, but this is interest receivable. We'd want to keep that separate from our notes receivable and also separate from our accounts receivable. We want a separate account for our interest receivable, not to be mixed. So that's at the end of year 3. Then we fast forward. Now it's October 31st, year 4, and it's time to collect. So Stanford Cummings is going to pay us, and we're going to collect the principal of $15,000 plus the full year of interest, $900. But before we can collect, we have to accrue the remainder of the interest. So we've already accrued 2 months, November and December from last year, and now we have to accrue the rest of it. So again, principal times percentage times time outstanding. So we take 15,000 times 6% times the other 10 months, 10/12, and that equals $750 of accrued interest revenue. So again, we're debiting interest receivable, crediting interest revenue, bringing both sides of the accounting equation up. What's our balance in interest revenue now? It was $150 from last year, and now we just put in another $750, so now we're at $900, which is $15,000 times 6%, and now we're ready to collect from Stanford Cummings. So now that the entire $900 of interest receivable has been accrued, ATS records the collection of $15,900 in principal and interest on the note. So we're debiting cash $15,900, and then we need to split out our credit. We credit notes receivable for $15,000, the original principal, and we credit interest receivable for the $900. I really don't like the way they show this over here. They just have NA. Why do they just show NA? Well, this is just one giant asset exchange, but couldn't we give a little more detail? Here's what it should look like. So we're debiting cash, $15,900, crediting notes receivable, so it's going down, it's all been collected, and we're crediting interest receivable, $900, it's all been collected. So it is a big giant asset exchange, but with more detail, it should look like that. What I do want to point out over here under cash flow, $15,000, when we loaned out the $15,000, it was IA. When we collect the $15,000 of principal back, it's IA, investing activity. But the $900, it needs to be spliced out. It's OA. Interest, no matter what, for cash flow purposes, whether it's going in or coming out, interest is always going to be OA, operating activity. So when we receive that payment of $15,900, we have to be careful to separate that in our cash flows. So that's something to watch for. Make sure as you're doing your homework, I'm pretty sure you've got a good notes receivable, interest receivable problem in your homework. Make sure you pay attention to that in terms of your cash flow types, OA versus IA. So next we've got credit cards. A lot of businesses, rather than extending credit to their customers, they don't do that anymore. They tend to allow their customers instead to pay on credit card. It seems that most businesses these days don't extend credit in the form of accounts receivable to consumers, like business to consumer. If you go into the grocery store, you can't buy your groceries on account and pay your accounts receivable at the end of the month. Instead, you would use a credit card. But a lot of times business to business, they'll utilize accounts receivable quite a lot. But when we do business to consumer, credit cards are much more common these days. So rather than maintaining a credit granting department, meaning extending credit to customers and managing accounts receivable, many companies find it cost beneficial to accept credit cards. The credit card company, though, is going to charge a fee. They don't do it for free, and usually those fees are from 1% to 5%. And I will say I've never seen 1% nor 5%. I've seen maybe as low as 2% up to maybe 3.5%, maybe 4% tops. Yeah, I've seen 3.95. So these would definitely be your outer extremes. But when you think about it, on average, companies are sacrificing 2 to 3% of their revenue on credit card to the credit card processing company. So they're going to deduct that fee from the gross amount, and they have to pay the merchant then the net balance. So let's take a look how we're doing that here. So ATS accepts a credit card payment for $1,000 of services rendered, and we're assuming a 5% fee. So what they're having us do, I would start at the bottom. We know our service revenue is $1,000, so go ahead and credit service revenue $1,000. And then we're going to expense 5% of that. So 5% times 1,000 is $50. So go ahead and expense $50 to credit card expense. I tend to call it credit card processing expense or credit card processing fee, but it's an expense account. Regardless of the precise title, we're going to expense it on the income statement. And then debit accounts receivable for the rest, the other 95% that we're going to collect. I do want to point out, I would not use accounts receivable in the real world. I would use a separate account called credit card receivable. Accounts receivable specifically represents what our customers owe us. And our customers do not owe us $950. Their credit card company owes us $950. So I would have a separate receivable called credit cards receivable or accounts receivable hyphen credit card. I think some of your homework problems might use that. So we do want to keep that separated from what our customers owe us. But big picture, what they're doing is reporting all of the revenue, expensing the 5%, and the other 95%, the $950, we're going to collect soon from the credit card company. So there it sits in accounts receivable. Then a couple days later, typically it takes credit card companies about 2 to 3 business days to deposit the funds to the merchant's account. So a couple days later, the collection of the receivable due from the credit card company is recorded just like any other receivable collection. So now we're collecting the other 95%, which is $950 in this case. So we debit cash and credit accounts receivable. So an asset exchange, cash is going up, accounts receivable is going down, and our cash flow is OA, just like it would be if we were receiving it directly from the customer. We're collecting money on our previous sales, and that is exactly what we're in business to do. So that's OA for sure. So that's credit cards. You will run into a couple problems involving credit cards on your homework. One thing to think about, so we're sacrificing 2 to 3%, in this case 5%, for the privilege of accepting credit cards. Is that worth it? Why would a business want to sacrifice that percentage, 2, 3, 4, even 5%? Why are they willing to do that? Well, going back, rather than maintaining a credit granting department, and what they're referring to here is having people manage accounts receivable. Is it worth it? We have to pay somebody to manage our accounts receivable, send out bills, hopefully collect. What if they don't pay? We might have uncollectible accounts expense. Well, a lot of companies believe that, yeah, it's absolutely worth the fee of 1 to 5% to not have to have all that headache of uncollectible accounts and the allowance method and paying somebody to send out bills and hopefully collect for us. So we see a lot more companies doing credit cards these days and paying those percentages, hopefully more like 2 or 3%. So that's what makes it worth it, is that they don't have to do accounts receivable. So finally, we get to our ratios at the end of the chapter. We're going to take a look at the accounts receivable turnover ratio. And that's computed by taking our sales for the period divided by our accounts receivable. And what we're looking at here is the rate at which we collect our sales. So they tell us here the longer it takes to collect accounts receivable, the greater the opportunity cost of lost income. We want to be able to collect our receivables quickly. So let's say that we have sales for the period of 100,000 and our ending accounts receivable is 10,000. So what's sales of 100,000 divided by accounts receivable of 10,000? What? 10, you say? I'm sure you would have quickly shouted out your answer in the classroom. So we have an accounts receivable turnover ratio of 10. 10 what? $10? 10%? 10 what? The answer is 10 turnovers. What that means is that we can sell and collect, sell and collect, sell and collect 10 times during the year. Well, is 10 good or bad? We still don't know. With most ratios, you'll recall we need to compare them to something else. We should compare it to our accounts receivable from prior periods. We should compare it to industry averages. So we might want to compare that to something. In this case, with the accounts receivable turnover, typically this is usually our first step in then computing our days to collect. So we're going to compute our days to collect by taking 365 days, because I was told that's how many days there are in a year. I hope you already know that. So we take 365 and we divide it by our accounts receivable turnover ratio, which we had hypothetically computed to be 10. So what that would mean is that we take 36.5 days to collect our accounts receivable. And again, we don't know if that's good or bad without something else to compare it to. So we could track that number each month, each quarter, each year, and see if we can start bringing that number down, right? We want a lower number of days to collect. So this ratio is often going to help us simplify our collections as well, that to the extent that any customer gets above, say, 36.5 days, we're going to take more aggressive collection action with them and at some point decide to write off their account. So a lot of times we'll use our average number of days to collect as essentially a decision point in terms of our individual accounts receivables. Also, in terms of an operating cycle, the operating cycle is the average time it takes a business to convert inventory to accounts receivable and then convert accounts receivable back into cash, so then we can start all over again. And we compute an operating cycle simply by adding together our average days to sell inventory with the average days to collect our receivables. So, for example, remember at McDonald's, it took 7 days to sell that cheeseburger. So my cheeseburger's been sitting under the heat lamp. My cheeseburger with extra ketchup and extra pickles has been sitting under the heat lamp for 7 days. And apparently they're going to let me buy it on account. And on average, I take 17 days to pay them. And therefore, the length of our operating cycle is 24 days. Wait, what? McDonald's isn't going to let me buy on account. I have to pay for the cheeseburger right then. I don't know anybody that has a tab at McDonald's that they're going to pay later. That doesn't make any sense to me. Same with Starbucks, 47 days. My latte's been sitting on the counter for 32 days waiting for me, and then I'm going to take 47 days to pay it? That doesn't make sense. So where are these coming from? Most of these companies don't have accounts receivable. Well, they threw in one asterisk here, but I think it applies to a bunch of them. Estimate based on sales to franchise shops and retailers only. Most of these companies don't extend accounts receivables to their customers. What they're talking about here is the franchise restaurants or the franchise stores. They take a time period who pay their percentage up to corporate. So these days that we're talking about here is the time that it takes the franchise to remit their share of sales up to the corporate entity. It's likely not business to consumer accounts receivable. It's essentially intercompany. So that's what we're looking at there. But that's the idea with the length of an operating cycle. In terms of managing a business, we want to try to keep our operating cycle as short as we possibly can. And you'll see later in managerial accounting, we might use this operating cycle information to help us plan and budget and understand our cash flow. So that'll likely be revisited. Well, that's it for Chapter 7. I hope you've got a good grasp on accounts receivable and what to do when a customer doesn't pay, and understand why a company might choose to use credit cards instead of extending credit to their customers. You guys know where to reach me if you need any help.